Welcome back to Investing Talk podcast. Today we are locking in on a company that sits squarely at the heart of consumer finance and, well, the American auto industry, Ally Financial. Their upcoming earnings report, specifically the Q3 2025 results, are definitely an earnings event to watch, especially given the macro pressures they've been facing all year. Before we jump into the sources, just a reminder, hit that subscribe button, give us a like, and please leave a comment below. Your engagement really helps us know we're hitting the mark. And of course, if there's a specific company you want us to look into next, let us know in the comments.
Definitely. So our mission for this analysis today is really to be your analytical shortcut. We've synthesized a huge stack of pre-earnings analysis and contextual sources. We want to establish exactly what market expectations look like, which internal metrics really dictate Ally Financial's performance, and maybe most importantly, what kind of volatility the market is actually pricing in right now.
Yeah, we're cutting straight to the core insights you need. Okay, let's start with the basics. The schedule. Now, there were some earlier dates mentioned in initial analyst reports, but the confirmed date, straight from Ally's investor relations page, is October 22, 2025.
October 22nd, okay.
That's before the market opens, Eastern time. And there's a live webcast following at 9 a.m. Eastern.
So, yeah, just days away then. Let's talk numbers. What's the street saying? The consensus among analysts for the quarter that ended September 30th seems pretty tight. Revenue is expected right around $2.03 billion.
Right.
Which is, a rather modest 2% lift year over year. Not exactly setting the world on fire.
Oh, definitely not. And then on the profitability front, adjusted EPS. The consensus is $1.92. That's essentially flat compared to the same period last year. It really tells you the street isn't forecasting any heroic growth this quarter. More like maintenance mode, maybe.
Exactly. Maintenance mode is a good way to put it. But here's the first point of tension, right? While the official consensus sits at 92 cents, the whisper number, that unofficial feeling circulating among traders, it's actually a bit higher. It's at $1.94 per share.
Oh, interesting. So a couple of cents higher.
Yeah, and this immediately raises a question for you. Why is that whisper elevated when we know credit risk has been trending higher? Are investors maybe betting on some aggressive cost cuts in Q3? Or are they hoping Ally's pretty robust deposit strength will actually outweigh the expected loan losses? It's not immediately clear.
That's a great dynamic to highlight right out of the gate. And we have to connect this back to Ally's own promises, right? Their full year 2025 guidance set the EPS midpoint at $3.60. And crucially, they projected a net interest margin in between 3.20% and 3.30%.
That's the key range.
So if they miss this quarter, meeting those full year targets suddenly looks a lot harder, especially with that 94 whisper kind of hanging out there. Okay, let's unpack this. Let's maybe turn to history for a bit of context. How have they done recently? Well, Ally has a bit of a mixed bag when it comes to recent earnings surprises. In Q2 2025, they actually delivered a positive EPS surprise, about 0.05 cents.
Okay.
And the stock popped a bit, a responsive 2.1% the day after.
Oh.
But look back just one more quarter before that, Q1 2025, they saw a small negative miss, just minus $0.02.
Tiny miss.
Tiny miss, but the stock dropped 3.6% right after. It really shows the market is, hypersensitive right now. Any perceived deviation from these kind of flat expectations can trigger a pretty swift reaction.
Yeah, absolutely. Since the market is so reactive, we absolutely have to look past just the top line numbers, right? We need to focus on those internal metrics that truly matter to the balance sheet. And management has consistently flagged rising credit costs as the number one headwind.
Right, credit costs.
The primary indicator for this stress, it's the charge-off rate.
Okay.
Think of charge-offs simply as loans the bank has essentially decided are uncollectible. They have to write them off as a loss. This eats directly into profitability.
Makes sense.
In Q1 2025, Ally's charge-offs were 1.97%. That was actually a significant jump from 1.81% in Q4 2024.
Ooh, yeah, that's a noticeable jump.
It is. And if that upward trend accelerated into Q3, well, that's where the pain will be felt most acutely. That's the number to watch.
Right. So if charge-offs represent the credit health, the other side of the profitability equation for any bank is net interest margin, or N9.
Exactly.
The spread. This is the spread, yeah. The difference between the interest income they earn on loans, like auto loans, and the interest expense they pay out on their deposits. Ally's N9 was 3.28% back in Q1 2025.
Correct.
Now, they control this by either raising loan rates or, crucially, by adjusting what they pay their depositors. Given the current interest rate environment, maintaining that spread, that's tough work.
It really is. They do have one, let's call it a structural advantage, though, and that's their funding base. Deposit growth has actually been pretty robust. It hit $151.6 billion in Q1 2025, which was a solid 2% increase year over year.
Okay, so deposits are holding up.
Yeah, strong retail deposits provide cheaper, stickier funding compared to, say, volatile wholesale markets. That's a major silver lining in this kind of challenging environment.
That's a good point.
But we also need to layer in some seasonal awareness here. Our sources indicate that Q3 results often introduce a bit of seasonal softness.
Ah, right, seasonality.
Yeah, this is typically driven by things like auto lease runoff timing and just a general tendency for credit costs to tick a bit higher in the second half of the year. So the expectations we're looking at, that $1.92 consensus, it's already slightly tempered by this known historical pattern.
Okay, but these internal pressures, they don't exist in a vacuum, do they? What are the external macro headwinds that might be forcing management's hand right now? The major factor hitting Ally, obviously as a primary auto lender, is the softness we saw in the U.S. used car market during the quarter. The Manheim Used Vehicle Index reported that used car prices fell approximately 6% year over year through September. 6%.
Yeah, and that 6% drop isn't just a number, right? It creates this potentially dangerous cascading effect for Ally.
How so?
Well, when used car values decline, it immediately pressures the yields they can get on new loans. That's the obvious part. But here's maybe the critical analytical insight.
Yeah.
It also means Ally might be under-reserving right now for potential losses on leases they originated maybe 18 to 24 months ago.
Ah, the residual value risk.
Exactly. They have residual value risk. The value of the car at the end of the lease is lower than they projected when they wrote the lease. They have to absorb that difference. That is a direct hit to the bottom line.
Ouch.
And if we connect this to the bigger picture, it really helps explain why the entire consumer finance sector, where Ally lives, has lagged the broader KBW Bank Index by roughly 8% year to date.
Right, that's a significant lag.
It is. It signals that investors are specifically punishing the consumer lending segment. They seem to believe the credit quality issues are deepening faster there than, say, in regulatory or commercial banking.
And that broader caution is definitely reflected in some recent analyst actions too, isn't it?
Yeah, exactly.
You saw Morgan Stanley downgrade Ally to equal weight just back in September. They dropped their price target to $39.
Right. And Citi also reiterated a neutral rating, specifically pointing to that risk of auto yields compressing.
So the street's worried.
Essentially, yeah. The street is signaling some deep concern about the income side of that critical in equation we talked about. The one consistent positive note, maybe, is that management, under the new CEO Michael Rhodes, seems really focused on simplifying and enhancing the core auto banking business. And importantly, there's been no major negative regulatory action this quarter.
Right. Okay, let's shift gears a bit. Let's talk technical setup and maybe what the trading floor is betting on. Ally closed recently at $36.96, and it has drifted down about 8% since those August highs. So there's already been some selling pressure. This is where options pricing can give us a peek into collective investor fear or expectation.
Yeah, the options market tells a story.
So the market, using implied volatility derived from those options prices, is expecting a potential move of $2.10.
Okay.
Which translates to about a 5.7% move during the earnings week, up or down.
5.7%.
Here's where it gets really interesting. A 5.7% expected move for a major financial stock like Ally, especially with basically flat EPS expectations, that's kind of massive.
It is quite high.
That level of expected volatility suggests something, I don't know, maybe binary is possible or at least feared.
Well, to elaborate on that technical side for you, we see what's called an elevated downside skew.
Okay, what does that mean in plain English?
It means that options traders are willing to pay a much higher premium for puts. Those are the options that profit if the stock goes down than they are for calls, which profit if it goes up.
Got it. Protection is expensive.
Exactly. You can translate that elevated 25 delta put call skew simply as traders are buying expensive insurance against a big drop. The market is paying a high premium right now to protect against that downside scenario. It signals that the collective fear premium is already kind of built into the options price structure.
Okay. So given those high stakes and that fear premium, we can really distill the report down to those two sort of non-negotiable metrics that will likely drive that 5.7% swing one way or the other.
Right. It comes down to a couple of key things.
As we've discussed, first is that net interest margin, NIM. Does it stay within, or maybe more importantly, do they reaffirm the company's guidance for 3.20% to 3.30%? That's huge.
Right, Schultz.
And second is the charge-off rate. Does management finally stabilize this vital credit indicator, Or does it continue that upward trend we saw from Q1? That would signal accelerating stress, particularly in the subprime part of their portfolio.
Exactly. Those are the two big ones. And based on combining the analyst models and that option skew we just talked about, we can kind of structure the potential scenarios. The sources assign a base case confidence, which is, neutral and centered on those consensus numbers we mentioned. But the extreme outcomes are defined.
Okay, lay them out.
All right, the bull case. This is assigned about a 25% probability, so not the most likely, but possible.
Okay.
This would probably require revenue pushing towards $2.5 billion to $2.08 billion. And EPS towards the top end of that whisper number, maybe $0.95 to $1.02.
And what drives that?
This would likely be driven by NIM resilience, maybe holding steady, and crucially, surprisingly lower charge-offs than expected, perhaps even showing some stabilization. Plus, continued strong deposit growth that lets them fully reaffirm their full-year guidance.
Okay, that's the bull case. What about the bear?
The more dangerous, but actually seen as less likely, bear case is assigned maybe a 15% probability.
Lower probability, okay.
This would see revenue dipping closer to $1.97 billion to $2 billion, and EPS potentially plummeting into the $1.84 to $0.89 range. Well below consensus in the whisper.
I have a trigger for that.
Compressed NIM, likely due to that yield pressure from falling used car prices, and significantly higher charge-offs, really showing stress in the subprime book accelerating. That would almost certainly force management to cut their full-year guidance.
Gotcha. So weighing all that, the cautious analyst commentary, the sector lag we talked about, and especially that high downside skew in the options market.
Right.
The overall leaning from our sources seems to be neutral to slightly cautious heading into October 22nd. Is that fair?
I think that's a very fair summary of the prevailing sentiment. Yes, cautious optimism seems too strong. Neutral to slightly cautious feels right.
Okay. Now, let's look just beyond the immediate earnings call for a second. What actions or external news could maybe drive volatility in the next few months, regardless of the Q3 numbers themselves?
Yeah, good question. There are always other factors. One strategic catalyst that has been, rumored in the industry is that Ally might consider divesting a portion of its auto loan portfolio.
Selling off some loans.
Potentially. If they were to sell off some of those loans, the goal would likely be explicitly to enhance their capital ratios and maybe free up some cash. That could be a proactive move welcomed by the market, especially if investors are worried about that rising charge-off trend continuing.
That makes sense, yeah. De-risking the balance sheet might be seen positively. What else? Other near-term data points we'll definitely see. Well, there's a quarterly dividend payment scheduled for November 14th. That's always noted.
Standard stuff.
Then we get crucial sector data from Black Friday and the subsequent holiday car sales reports in late November. That'll give us the first real-time insight into Q4 loan demand.
Absolutely key data point for them.
Right.
And we also have, recurring speculation about their technological edge. Management has hinted at potential major upgrades to their digital banking platform or maybe even a new product launch. That could be a positive surprise.
And buybacks.
And buybacks, yes. If they announce an accelerated share buyback program, especially alongside a strong deposit outlook, that could also provide a significant lift if the stock remains kind of depressed relative to its peers.
Okay. Lots to watch even after the print.
Definitely. So to kind of synthesize the core tension we've unpacked here, Ally Financial is currently navigating this really difficult channel, right?
Yeah.
Rising credit losses on one side, auto market softness on the other.
Yeah.
This just means that the net interest margin and the charge-off rate are the absolutely critical indicators they'll measure management's ability to maintain profitability under pretty significant economic pressure, especially with that 6% drop in used car values still kind of lingering overhead. What's fascinating here is just how the market is clearly hedging against that worst-case scenario. That expensive downside insurance, that put skew, is probably the biggest signal of institutional caution we have right now.
Which brings us perfectly to our final thought for you, the listener, to consider. Given that higher than average put skew we noted in the options market, meaning the potential bear case is already kind of costly to hedge against, how much of that downside is already priced into the stock sitting there around the $37 level?
Right. Is the bad news already baked in?
Exactly. And maybe more pointedly, what kind of positive surprise, specifically in that charge-off rate stabilization, would actually be necessary to truly overcome that downside anticipation and spark a sustained rally?
Yeah.
That's really what you need to mull over as we head toward the 22nd.